If you have spent any length of time, no matter how short or long, looking into long-term investing, you would have almost certainly heard this phrase at some point.
If you pay too much for them, you can turn a good business into a bad investment. But if you pay an appropriate price, you can do all right.
The price you pay for a stock, the amount of money you outlay in exchange for part ownership in a business, is a huge factor in determining how well the investment performs for you. And the way that we figure out what price to pay is by first calculating what the business is approximately worth, also known as intrinsic value. So today I'm going to be explaining exactly what intrinsic value is. I'll show you the raw mathematics behind how to calculate it, as well as give you a free intrinsic value calculator to make the tricky maths part as easy as it can be. I'm also going to explain the 3 key inputs that we need to find and calculate in order to reach intrinsic value. And finally, towards the end of the video, I'm going to show you a real life example of how I calculated intrinsic value for one of the biggest investments that I ended up making in my portfolio in 2020. So if you do get some value out of today's video, then I would very much appreciate it if you take the 2 seconds to leave a like on the video. And if you want to see more content like this in the future, then consider hitting that subscribe button to stay up to date with content that I post in the future. But with that said, let's jump into the video.
Well, intrinsic value is what is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of business is. In other words,
according to Warren Buffett, intrinsic value is the total amount of cash that a business returns to us over its remaining life, discounted at an appropriate rate. To put it more simply, what is the business returning to us? What do we get out of a business after we buy it and hold it over the long term? And as I'm sure you're aware, the ways that you get money from a business there's a number of ways, right? You can get money from a business primarily from cash dividends that are paid directly to you. So when the business decides that they want to take some of their profit and deliver it to its shareholders directly. But it also comes in the form of when businesses retain cash within the business and use it to grow the value and therefore the price of your shares over time.
The only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about.
So we want to find a way to estimate what cash a business is likely to produce in the future and then discount it back to the present value. Now, I might have lost a few people with that last line about discounting, but the concept of discounting is not as difficult as it sounds. Essentially, what we are trying to achieve with discounting is reflect the different value that $1 has depending on when we get it. So let's start really simple. Let me ask you a question. Let's say I have $1 and I'm offering it to you. Would you rather that I gave you that $1 today or in 10 years' time? Now, obviously, you would say that you would want the dollar today, but the reason mathematically that is the correct answer, and the reason why $1 today is actually worth more than $1 in 10 years, is because if you receive that dollar today, you could, at the very, very least, put it in a savings account and earn some small level of interest on that dollar over the next 10 years, therefore meaning $1 received today is actually worth a little bit more than $1 in 10 years' time. And we don't just need to talk about $1 today versus $1 in 10 years. The concept basically means that any amount of money received today is worth more than the same amount of money received at any point in the future, whether it's tomorrow, a year, or 10 years. Discounting future cash flows is the mathematical process of taking cash flows or cash that is received in the future and discounting it, bringing it back to what it is worth to us today based on what return we're trying to make on our money over that period. And to give you another simple example, if we want to double our money over a 10-year period, then $100 received in 10 years is worth $50 to us today, right? If we're trying to double our money over a 10-year period, then $100 in 10 years is worth $50 to us today, in the same way that $1 in 10 years would be worth 50 cents to us today. So now that I've explained what the concept of intrinsic value and future cash flows and discounting is, how do we actually go about calculating this? Well, there's a formula that we can use. It's a formula that Warren Buffett is quoted using to calculate intrinsic value, and that is the discounted cash flow formula.
So you got formulas involved in finding intrinsic values on certain companies. system. You've got a mathematical system set up.
Discounted present value of future cash, yeah.
Okay.
The formula takes cash flow produced by the business in each of the next 10 years and then discounts them back to the present day at a specified rate. And then we also add what's called a terminal value at the end to reflect cash produced by the business after the 10th year. Now, I'm not going to go into the details of explaining terminal value in this video because that's an entire topic of itself, but I do have a video dedicated to explaining the different types of terminal value we can use and which one is most appropriate for what we're doing here, which is business valuation. I'll leave that video linked down in the description below if you want to pause and watch it, or you just want to watch it at a later date. But to save you time going through and doing raw mathematics, I'm not going to make you get a pen and a piece of paper and a pencil out and get your old calculator out and start crunching some numbers. We can all do this with the power of spreadsheets now. Particularly Google Sheets is my favorite way to run these calculations. So if you're interested, you can download a free copy of the Intrinsic Value calculator that I put together and have been using over the past few years. There's also a bunch of other stock analysis things within the spreadsheet, but today we will be, of course, focusing just on the discounted cash flow section of that spreadsheet, but use the link down in the description below if you want to download yourself a free copy. On the download page, you'll notice there's a bunch of different spreadsheet options. If you want to follow along with today's video, then the spreadsheet we will be using, and the one that I use most of the time anyway, is the 10-year spreadsheet for 2021, and of course the latest version. Taking a look at the spreadsheet for the first time might be overwhelming, but it's really not complicated. There's basically 3 key inputs that we need to add into this formula in order to get our desired output. Our desired output, of course, is the intrinsic value, or the price that we're willing to buy the stock at. The first input is that we need to estimate the cash delivered to shareholders in the previous year. And the figure that we want to enter in here mathematically is either called cash flow for owners, that's what I call it, or owner's earnings, which is what Warren Buffett calls this figure. Now, again, I have a video dedicated to how to calculate this figure. I'll leave that linked down in the description below. Again, you can pause the video, figure out how to calculate that from that video, or you can just watch that video at a later date. Also, you'll see that we need to enter in some growth expectations. So what do we think the business will grow at per year for the next 10 years. This part of the process is the most critical part. It's the most important part by far, and it's also the part where people make the biggest mistakes. A lot of people think that in the future growth projections, you can just look at past growth, for example, look at revenue growth or profit growth from the past and just extrapolate it into the future. Expect that that's going to continue for the next 10 years, that the last 10 years will look exactly the same as the next 10 years. Other people will also rely on analyst expectations. What's the analyst consensus? What does the group of financial analysts that are giving advice to the institutional investors, what do they think the business will grow at in the future? Again, that's an easy way to follow the crowd, be a sheep, and make a mistake by following the majority of people investing in businesses, which is not what we're trying to do. We're trying to go against the consensus and outperform the market. What you really need to do here is take your deep understanding of a business and an industry and critically think about what is reasonable for that business in the future, given their current position, the potential for growth in the industry, and the businesses that they're competing against, and a wide variety of other factors. So when we get to the example part of this video where I go through a real life example, you'll be able to see a little bit better how I'm approaching this for a specific business. And then the third input is the required rate of return. And this is simply our target return. And I always fix this at 15%. 15% is the return we want to make. And the reason why I choose 15% is because you want something that's higher than the market average, which is about 8 to 10%, but you don't want to pick something that is so high that you will never find investment opportunities. And I find that when I'm looking at businesses and targeting 15% and then adding a margin of safety, which I'll talk a little bit more about later, but when I do that, there are very, very few investment opportunities that come around, but there's enough. Usually I've tended to find one every year or so while I've been investing, and that has been enough to build a significant portfolio. But if I was targeting a much higher higher return, then I would struggle to find opportunities frequently enough. So once we enter these three inputs in, what does the output show us? Well, it shows us a range in which we would be willing to invest in the stock. And basically, the range, if we set the required rate of return at 15% and our growth expectations are accurate, then if we invest in that range, we would make or should expect to make an approximate return of about 15%. However, we should not be investing just in that range. If we're targeting 15%, we should not be just entering in our growth expectations and then seeing what the intrinsic value is or the buy price and just buying at that price. We need to allow for a margin of error, a margin of safety for unforeseen things that can happen in the markets, right? Things like the pandemic will hit. There will be industry-specific problems that come up, business-specific problems that come up, regulation changes. There will be things that we just cannot predict that happen in the business environment, happen in the economy. And as a result, we always want to pay around 50% of a discount from intrinsic value, from the buy price that is spit out when we're targeting a 15% return. So for the rest of this video, let's go through a quick real life example of one of the most significant and most successful investments that I made in my portfolio. If you've been following along for a while, you would know this example because I've really only made 4 significant investments over the past 4.5 years while I've been investing, and each of them have been done using this process. And this is a really good example of how I applied intrinsic value to buy a great business at an appropriate rate. In this case, I'm talking about my Texas Roadhouse investment, which I made the vast majority of that investment, 90+% of it, in March of 2020. And since then, it has delivered me over 100% over the course of about a year and a few months. So it has been a very, very successful investment. And the reason why it was is because I knew what price was appropriate to pay. So how did I do it? Well, of course, we need to figure out what are the 3 inputs that we need. And one of those inputs will be fixed at 15%, right? The target return. So we don't really need to worry about that. But the first major input that we needed to calculate was what was an estimate of the cash flow that was returned to shareholders in the previous year. And what we're going to be doing is looking at 2019 because I used that figure and this calculation of intrinsic value to then make an investment in this company in 2020. So again, if you want a full tutorial on cash flow for owners, use the link in the description below and check out that full video. But essentially, I took operating cash flow and my estimation of maintenance capital expenditure and came up with an estimate for 2019 of cash flow for owners of $260 million. I then needed to come up with a range of reasonable growth rates for the business in the future. And instead of just looking at past growth and projecting it into the future, I thought critically about this business and what is reasonable for it in the future. And for this restaurant chain, there's really 2 major factors that influence revenue. So the top line, before we get down to profitability, that's going to be the number of restaurants that they open over the next 10 years. And then what is the revenue per restaurant? Is that going to go up substantially or go up modestly or go up at all? So for example, when I'm projecting forward what is reasonable for restaurant openings for Texas Roadhouse, I'm thinking about things such as what is their current expansion rate? What's the cost to open new restaurants? How much capital do they have available to them? And what density of restaurants do they have in some of their most local areas? And can they achieve that kind of density as they expand across the US and then also internationally? And from projecting the number of restaurants to the revenue per restaurant, and then combining that with an estimate that profitability or cash flow margin will remain pretty stable as it has over the past decade, I'm able to come up with a projection of what I think cash flows will look like in the future, and therefore come up with a projected growth range. And when I entered those inputs into my discounted cash flow, I got a buy price per share range or an intrinsic value range of between $25 and about $50 per share. Then on top of that, I of course needed to add a 50% margin of safety. So that meant that I was targeting somewhere between about $12 to $13 up to $25 per share to invest in the business. And when I first did this analysis, the stock was sitting at around $50 per share. So this seemed insanely low that no stock would ever fall that far. But fast forward to March, there was a problem that severely impacted restaurant businesses in the United States, that being the pandemic, of course. And the stock fell all the way to about, I think at its lowest, it fell to about $25 per share. And I was able to invest significantly into the business at an average of around $31 per share, which was slightly outside of my range, but I was pretty much getting a 45+% margin of safety with reasonable growth expectations as well in what I think is a really, really good business. And that's how I go about it. So I know this has been a really, really long video. So if you've stuck around to the end, then props to you for doing so. And if you got some value out of this video, I would very much appreciate it. Take the 2 seconds to leave a like on the video and also let me know your thoughts down in the comment section below. I'll be down there answering comments and questions as this video goes live. But with that said, I hope you guys have a great day and I'll see you in the next video.